due to the demand, there could potentially be more paper than there are bars standing behind it. That opens the door. People are wondering more or less if gold and silver have topped. Is that correct?
This bubble is ripe to pop overnight. Prices were marked down very, very heavily. Now, I would suggest that there is some indigestion, if you like, in the Shanghai futures market, Shanghai Gold Futures Exchange.
I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100-to-1 at a minimum. My target is 50-to-1.
In today's news recap, gold and HQLA correcting misleading online information. There have been inaccurate reports online that gold will be reclassified as Tier 1 HQLA, high-quality liquid asset, under Basel III as of July 1st, 2025. This information is not correct. No official announcement has been made or is expected on gold gaining HQLA status. Why is there confusion? There's a lot of online misinformation about Basel III more broadly. Related to gold specifically, various websites state that gold will be reclassified as Tier 1 HQLA on July 1st. Let's pause here. Tier 1 refers to capital rules that were written in the original Basel Accord in July 1988, which became known as Basel I. HQLA is a function within the liquidity rules of LCR and NSFR, which were first written into Basel III and implemented by Basel on January 1st, 2019. People are getting mixed up between capital rules and liquidity rules. LBMA is advocating for gold to be reclassified as Level 1 HQLA. Again, note this isn't Tier 1 because HQLA relates to a liquidity rule. A lesser number of articles say that gold is due to become Level 1 HQLA. But again, this isn't correct. As stated above, no announcement has been or is expected. Gold is already a Tier 1 asset under the Basel Capital Accords, meaning that it has a 0% risk weight. This is true for all three Basel Accords. The rule states that gold held in a bank's own vault is deemed as a Tier 1 asset with a 0 risk weighting. Nothing has changed since the original Basel I Accord was created in 1988. Gold is not due to be reclassified as a Level 1 HQLA. If it were, we and the WGC would be the first to shout about it. LBMA continues to advocate with the central bank and prudential regulatory community that gold meets all criteria to warrant HQLA status. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering US coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
Reduce reliance on the United States and of the dollar, and this is de-dollarization on a global scale. You're seeing just over the last couple of years, the Reserve Bank of India has doubled their gold reserves from 2.5 years ago. And you look at what China is doing. I mean, look. First of all, the amount of gold that China has is far more than they lead on to, as far as I'm concerned. And I mean, there's all sorts of evidence that points to that. They've opened up their insurance industry into buying gold, and albeit just a very small percentage. If they open it up even on a broader scale, the amount is extraordinary in terms of how much that they could actually bring in. We just talked about Poland and the amount of gold that they're bringing in, and now you have China that is at the same time allowing their banks to, or accelerating their their accumulation through their banks by raising import quotas and allowing those banks to buy more U.S. dollars first to fund these purchases, which kind of, it's a dual move in the respect that first it meets the demand for more gold, the surging demand, but it also subtly reins in the yuan's appreciation against the dollar, which is something that I think Trump doesn't like, but that's a strategic move. And it's a hedge against not only the global volatility by accumulating all the gold, but also it signals ultimately a shift away from dollar dependence. So in the twist, they buy dollars to slowly depreciate the yuan and then use those dollars to buy gold and have upped and doubled the import quota. So they're slowly, they do things very methodically, not too fast to rattle the boat. They could have, everyone says, why not just buy it all at once? Because they would have cut off everything right there. Instead, they've been slowly and methodically on all different levels, from their insurance companies to here upping the quotas on the banks to state-sponsored accumulation programs through the Shanghai Metals Exchange. And now they're even going as far as trying to internationalize the yuan and gold settlement through the Shanghai Metals Exchange by opening other Shanghai hubs. First one is in Hong Kong. They're talking about doing one in Saudi Arabia and in other countries, part of their renminbi cross-border payment system that we've talked about, where they will trade in local currencies across this hub, this bridge, which is the M-Bridge technology, the technology that settles in 7 seconds instead of 3 to 5 days through SWIFT, at a 98% reduction in cost, and then settle imbalances in gold. And that is ultimately what they're trying to do. The two pushbacks that people gave about the BRICS is, one, they won't internationalize their yuan. This is what they are doing now. They're talking of opening up all of these hubs on behalf of the Shanghai Metals Exchange in these member countries in an effort to settle imbalances right then and there over the bridge network. And the second thing that is game-changing on all of this and needs to be said over and over and over again, and I have a habit of doing that, I've done that forever, but it's a narrative I want to drill it into people's head. The other pushback was that, well, it's just not a big enough block. Well, the fact that they are now opening up the bridge network to non-member countries like the Belt Road and the Shanghai Cooperation Organization and the Eurasian Economic Union and these ASEAN countries and the Middle East countries, you're talking potentially north of 90% of human population that will be able to trade outside of SWIFT over the bridge network, settle in 7 seconds with a 98% reduction in fees, no Western interference, and then settle imbalances in gold. That's where we're going. You can see this is the plan that they have, and doing it very subtly. But it's not just China that's doing it. You're seeing all of these countries accumulate gold, all of them. And the countries they're associated with are very resource rich in all forms of commodities, many of them underdeveloped, but that's the whole point of the Belt Road. This whole thing is connected, and it's starting to accelerate. And maybe that's the realization that the Trump administration knows. And that's why they're hell-bent on accumulating commodities the way that they have been here in the country, and then also delivering them and not leaving them in paper so they can just float right back to England or Switzerland through exchange for physical or whatever the other vehicles that are available to the traders around the globe. Maybe that's why they're moving them into eligible, out of registered, or even taking them off the exchange so that they're no longer a free game to be traded and sent backwards.
In today's news recap, price pullback spurs gold demand in top Asian hubs. Physical gold demand improved across most key Asian hubs this week as a pullback in global prices sparked buying interest among consumers. This week, Indian dealers were offering a discount of up to $34 an ounce over official domestic prices, inclusive of 6% import and 3% sales levies, compared to last week's discount of up to $16. Demand was better this week compared to last, thanks to the price drop. But a lot of buyers are still waiting it out, hoping prices dip even more, said a Kolkata-based bullion dealer. Prices need to settle down a bit. If gold drops another 2,000 rupees and hovers around 90,000 rupees, we could see demand really take off, said a Mumbai-based bullion dealer with a private bank. Spot gold trading around $3,216.17 on Friday. It hit an over 1 month low of $3,120.14 on Thursday and is set for its biggest weekly decline since November. Dealers in top gold consumer China charged premiums of $9 to $50 an ounce over the global benchmark spot price, compared with premiums of $42 to $49 last week. The correction in gold prices has for sure encouraged some bargain hunting and a good entry point for those who may have missed the move higher, said Ross Norman, an independent analyst. We expect jewelry demand to stabilize over the coming quarters. Retail investment demand will likely be strong, given the compelling investment case for gold, ANZ said in a note. In Hong Kong, gold was sold at par to a $2 premium, while in Singapore, gold traded at par with the global benchmark to a premium of up to $2.50 per ounce. In Japan, bullion was sold at a premium of 25 cents to 50 cents. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
While the stock market was rallying and, gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500. And this morning, it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks. And that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning, and, it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news. Nothing happened. Somebody just decided to dump, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today. So about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. It's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver. So if you missed out on $2,000 gold, just buy silver, because as far as silver is concerned, gold is still 2,000. Anyway, you can buy both metals. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current price.
The liquidity has very much come from leasing, central bank, leasing of central bank gold. I mean, that was clear, and it was proved by the fact that bullion banks were queuing up to take gold out of the Bank of England vaults. I mean, these are banks which have accounts with the Bank of England. So it's possible for them to store some of their gold there, but they would tend not to. Therefore, at least a large amount of the gold that came out of the Bank of England was effectively leased gold, and it was taken by bullion banks who were benefiting, if you like, from the spread between futures, which were trading at a huge rate, interest rate premium. By interest rate, I mean compared with the gold lease rate. It was a simple interest rate arbitrage. Now, that is now stopped. And if you look at the COMEX warehouse gold stocks, they've now begun to decline. So that process is over. Furthermore, it was only week before last, I was in London visiting someone in Throgmorton Street, behind the Bank of England. The doors were firmly shut. There was nothing going in or out. So I think that process is over. But it does raise the question, quite rightly, that how much liquidity is actually left within the system here, because we get vault reports from LBMA authorized vaults, as it were, and they have declined a little bit, but not hugely. But most of the gold there is owned by someone, as opposed to being, if you like, the liquidity for the bullion banks to draw upon. So it's an interesting. It's a question we would all like to know the answer to. My guess is there is less liquidity there than the numbers would suggest. Quite a lot less liquidity. I wouldn't be surprised if we're looking in the hundreds of tons rather than the thousands of tons. So, and this is very important, given that the demand from China and other East Asian nations, seem to be continuing apace. They're continuing to get hold of virtually every ton of gold that becomes available. So, yeah, the liquidity situation I don't see really improving.
What's your take on Salente's new outlook? Do you think $3,000 gold is realistic this month, or are there more hurdles ahead? Will central banks continue to gobble up all the gold? It's funny that Gerald Celente has shifted his forecast after being bearish for like 2 weeks, becoming bullish on gold as he sees current market conditions driving prices higher. Share your thoughts and price predictions in the comments. Let's see how this plays out in the coming weeks. Now, watch this video right here because it's a perfect fit for you, and I'll see you on the other side.